So we're into the 7th episode so far of season number 2. And so far we've struggled to find any companies that can score a positive, clean score. Today we're going to take a look at Porvair Filtration Group, and I think we're in for something a bit more tasty. Hey there guys, welcome to the FTSE Show. My name is Chris Chillingworth. This is the show dedicated to the analysis of UK FTSE stocks. Today we're going to take a look at a company called Porvair Filtration Group, who you probably haven't heard of. Most investors, certainly beginners, will probably never have come across this stock before. They're not really a household name, but quite a well-established company. They've been running for quite some time now. Let's go into a few details about this company, just to kind of give you a kind of heads up on what they're all about before we start to look at the financials. So these guys are specialists in the production of materials and the overall supply of filtration and separation solutions. So these guys essentially make filtration devices and apparatus and the materials for them. They have clients in the aerospace and defense sector, food and drink, gas, electronics, molten metals, water treatment plants, nuclear facilities, presumably that's power stations, pharmaceuticals and printing sectors. These guys produce nuclear filters, metallic filters, disposable filters, compression filters, filter housings, flow and sound control, gas filters, chemical filters, and many other specialization products. Not very exciting. Certainly, you know, this is why they're not a household name, but that doesn't make them a bad investment. And this is very quickly, this is one of the areas where beginner investors become unstuck, because when people start to invest on the stock market, they invest in companies they've heard of. They invest in companies that they've shopped at or whose products they've bought before, but that doesn't make them a good investment. Just because you like a product or you like a shop doesn't make them a good investment. What makes them a good investment are things like the risk and the return and the reward. And what are you going to get for the money you put in and that sort of stuff. So, you know, we need to start looking at this from a different point of view. And this is hopefully what the show kind of at least goes some way towards helping with. They have their own laboratories and engineering premises, so this is quite serious stuff, you know, and a fair amount of R&D goes into this as well, research and development. Many of their products work towards making the environment better and cleaner. Many of their products are deemed mandatory use, this is quite important, for their clients. And they also need cyclical replacement. So these guys are making filters that are mandatory for companies. So companies want to operate in these sectors like the nuclear sector, the pharmaceutical sector, the molten metal sector, all of these filters are mandatory. They can't operate without these filters. That's a great business to be invested in. Not the only reason why you would invest, but it is a good start, because here is a business that's producing something that people not only need, but must have. They also need cyclical replacement. So essentially there's a life cycle to these particular filters, and these filters need to be replaced. That's, again, another great business aspect, a great business model. Products must pass accreditation to perform to a specification. So they can't just churn out these cheapo products that need replacing really quickly. They have to pass an accreditation process. They have to perform to a certain specification, but they still will need cyclical replacements. It's kind of the best of both worlds. It's a good quality product, but it will need replacing at some point. 45% of their revenue comes from the US, so that's predominantly where the business is based. 30% the UK. So there, you straight away you've got 75% of all revenues coming from the US and the UK. 20% comes from Europe, and the final 5% comes from China. They've got strong organic and acquired growth strategy in place, with a number of recent acquisitions made to the manufacturing capacity of the business. So these guys, organic growth is essentially finding new clients, essentially just what the normal growth that you would expect of a business in terms of finding new customers, finding new sectors to work in. Acquired growth strategies when they go out and they buy a business and they bring it in under their umbrella. and they go out and they actually purchase these companies and bring them under their wing, the acquisition process, or it could be mergers. So they've got a combination of both. They have an organic growth strategy, and they go out and acquire companies. And the acquisitions they've been making have been made to the manufacturing capacity, so their ability to make more products every single year. They've got bases in the US, the UK, and China. They acquired Fairy Filtrex in 2001. So these guys have been around for quite some time. If you look at the Porvair Filtration Group chart, the EPIC code is PRV. You'll find that their charts go back to 1995 in most cases. So yeah, they've been around for quite some time. They are a FTSE small cap stock, and they've got 238 million market cap. What does market cap mean? For anyone that's unsure, essentially market cap is the number of outstanding shares that the company have multiplied by today's share price. So in other words, if you wanted to buy every single outstanding share in this company like that and own the whole company, it would cost you 238 million today. So let's take a look at the vertical analysis then. So as we can see straight off the bat, we've got 2013 to 2021. 2022's data is not out yet. It will not be out until January 2023, and the annual report won't be out until March 2023. So we've got some time to wait for that. 2021's data only came out in March, and it's now June. So we've only recently had that data come through. But as you can see, revenue has been relatively strong growth there. We've gone from 84 million to 146 million over 2013 to 2021. A little bit stagnant from 2019 to 2021, but that'll be because of the pandemic. It's caused a lot of disruption across the entire world, and certainly for businesses. And yeah, the fact that they've managed to maintain that level is good. Cost of sales, that's relatively healthy. We've got our gross profit underneath. Gross profit has been growing. So whilst revenue has been going up, cost of sales has been going up. The cost of sales has not been rising quicker than the revenue, which is great because it means the gross profit has been growing. As a percentage of the revenue, we're looking about 32-33% per year. It's a bit low. We'd like to see them making a bit more. This is gross profit. This is not at net profit. So there's still some things to be deducted from this, and at the moment they're still only at 32% a year. So that profit margin is quite low to start us off with before other deductions. That doesn't mean they're a bad investment, it's just a bad start. It's not great. It means that it's expensive for them to run their business and what they do. Then we take a look at the expenses. Well, the expenses as a percentage of the gross profit are okay. They're running at about 70%, between 66 and 70% a year. That's relatively healthy. It's on the higher side, but it's within a threshold of what I would be looking for as an investor. And these expenses have never really got out of hand. They look very good. They're very consistent, which is nice. You kind of know where you're going to stand then as an investor into what that expense ratio is going to be. And then we can look at the operating profit. So of the gross profit, with the expenses taken out of running that business, what's left is operating profit. This is pre-tax profits. So we've still got taxes and a few other expenses to come out. But operating profit looks healthy. I mean, we're seeing some real growth there, aren't we? 2013, they were making 8.3 million a year. Now at 15, nearly 16 million in 2021. And bear in mind, we've had a pandemic. And it's caused a hell of a lot of disruption to a lot of companies. We can see here that actually 2021 has been their most profitable year, which is quite rare. Most companies that we have been looking at did okay in 2019, had a torrid time in 2020, and then in 2021 they made up some of that difference but didn't quite reach 2019's level. So the fact that they've actually beaten 2019's profit is actually quite good. And the revenue went up a little bit as well. What they've managed to do, by the looks of things, is cut their expenses down in 2021 because they've fallen to only 66% of the gross profit, whereas previously we're looking in 2019, for example, at 69% and then 71% in 2020. So they've obviously done something to reduce those expenses down while still being able to make the revenues they've made, and that's given them a bit more operating profit. So that's good business. That's a good job. earnings analysis. So let's take a look at this then. So we've got our operating profit across the top here. We've got finance expenses, that's interest on debt, no issues there at all, that's very low at 1 million a year. Sale of assets, there's nothing to report, no other income. Obviously taxes, and then so therefore the reported profits and the true profits are going to be matching because there's no extraneous weird income or expenditures going out. And so as we can see, yeah, true profits, they made just shy of 12 million in profit in 2021, and that was their best year. I like the fact that this is a company that had their best year in 2021, in a year when many companies were still trying to rebuild and still trying to get back to their highs of 2018 or 2019. Porvair were already there. They're already making record profits in 2021, so that's great. Profit percentage, that's what's the percentage of profit relative to the revenue that came in? 8% as of 2021. It's a little bit on the low side for me. 8% for me is just a bit too low. It's great, don't get me wrong. This is a company that are doing very well. Look at this trend. From 2013, 2014, about 6% a year. Then they spent a number of years at 7% a year. 2020, we obviously dropped back down to 6 because of the pandemic. That's fine. We're back up to 8% now. So this is a new high of 8% a year profit. It's lower than what I would invest in personally, but it's healthy, it's good, it's things moving in the right direction. I mean, when these guys make it to 10, 11%, that's a whole new ball game. These guys are in good shape. It's just a little bit thin for me. To me, at this stage, before we've looked at other things, this is looking like a potentially good investment. We've obviously got a lot of other things to look at first before we make that decision, but so far, so good. However, I know there are companies out there in the FTSE market that are producing much higher profit margins, and I would prefer to invest in those more secure companies than this company. But this is still a good solid business by the looks of things. Let's take a look at the debt analysis. So how are they handling debt? So we've got our true profits across the top here. So what the actual profits that they're actually making. Then we've got short-term borrowings, of which there's very little to even speak of. And in 2021, it's at 0, so nothing to worry about there. And then you've got long-term borrowings. So this is borrowings that need to be paid back within the next 2 to 10 or even longer years. So short-term borrowings is money that's got to be paid back, or borrowings that have got to be repaid within a year. And then long-term is long-term, essentially, anything over a year. So they've got 5 million in debt outstanding. Well, this is a company that's making a true profit of nearly 12 million. So that is well within their means. They are not biting off more than they can chew. We can look at the earnings to debt ratio. Anything bigger than 4.0 is a bit of a concern. They're starting to bite off more than they can chew. But as you can see here, this is a company that have handled debt very well relative to their earnings power. They've never bitten off more than they can chew. They've never taken on too much debt relative to their earnings power. In fact, they rarely touch debt, I would say. To only have 5 million of borrowings there, that's a good situation. It's nice and healthy. It's going to keep that interest on debt paid down as well. It's going to keep it low, so it's going to maximize profits. So equity analysis, we've got our assets across the top here. So the value of all the company's assets on a year-by-year basis. As you can see, there's been some wonderful growth there. Liabilities also have been growing, but here, notice in 2021, we've actually seen a drop of 7 million in terms of the value of the liabilities, the value of all the debts and the liabilities that they own. So that's great, because we've seen a growth in assets, but a drop in the value of liabilities. That's going to obviously help out the net worth. And the net worth is the third line here on this table. And the net worth is essentially the difference. It's the equity of the business. It's all of the assets that they own minus all the liabilities that they owe. What's left? And for the first time in their history, they've made over 100. They've got over 100 million in net worth. So this is a company that's growing not only in terms of its profits, but it's growing in terms of its overall business value as well. So that's good, because if you're going to come in and swoop in and buy all those shares for however much they cost today, we'll come to that in a moment. I think it was 238 million? 238 million market cap. So if you're going to buy all the shares today for the today's share price, it would cost you 238 million. You could immediately inherit a net worth, a business that has 170 million's worth of assets, has 60 million worth of liabilities, and therefore has an equity or a net worth of nearly 110 million. So yeah, not bad. And then you've got retained earnings underneath. So that is what's left. It's like a pot of money that every year you'd want to see increase in value, essentially. So it's the money that's left over in the business that's not been paid out on dividends, that's not been used for acquisitions, that's kind of like a savings pot that's growing. And we want to see that grow. And it's been growing really well over the last, 9 years. So yeah, good stuff. So pricing analysis then. Can we price this company up? Yes, we can. Today's price is £5.40 a share. I have worked out, based on the earnings on a per share basis and looking at the equity value on a per share basis, I would deem £3.20 or anything up to £3.20 to be cheap, anything up to £3.60 to be a fair price, anything up to £4.20 to be a stretch price, so a price that we would be willing to stretch to but would rather not pay that much. And then anything over £4.20 for me is overpriced. So today's price of £5.40 is overpriced. It's just a bit too high. We want to see that come down a little bit more before we really start to jump in and see that this is a bargain. But this is a good stock. So this is a company that you probably want to put in your watch list. And just keep an eye on and look out for that £4.20 price. Obviously, what we would be willing to pay changes as the earnings change, as the net value changes, as the number of shares outstanding changes. All of these things that fluctuate affect what we would be willing to pay. But as of now, as a snapshot, as of today of recording this video, anything over £4.20 I feel would be overpriced. They do have a dividend. They do pay a dividend. That dividend is 5 pence per share. So not great. It's not a great dividend. It's about 1% yield per year. 5 pence for every £5.40 share that you own. So it's not a particularly great dividend, but at least they have a dividend. A lot of these small cap stocks they're not big enough to even be able to pay a dividend. So at least you get something, even if it is just 1%. 2020 news, there isn't any. I've looked up, I've done some research to see if there's any information that's come out. This is quite typical of small cap stocks. They tend to not release as much in the press. There's not so much news to find out about. And you have to kind of wait till the actual specific year-end date, before they'll actually report anything. So there's no 2020 news. We don't really know how things are going. We are due an interim report, so a half-year report from them in July, so that's next month. So if this is a company that you're interested in, you want to look into a bit further, you might want to put something in your diary for July 2022, next month, to have a look at their interim report and see how things are going. But the full year report, the one that really matters, comes out in January 2023, and we would expect their annual report for 2022 to come out in about March 2023. So looking at the table then, looking at the scoreboard, as you can see, they've jumped straight in there at second place. So they've done pretty well. Not quite as good as Antofagasta in terms of investment opportunity. They've still scored 52. It's a respectable score. If you've watched the show before, if you've seen season 1, you'll know 52 is pretty decent. It's not quite the level that I would invest in. There are better companies out there. However, not a bad investment, and you could do much worse, is I think what I'm trying to say here. There are, in the grand scheme of sort of 950 shares in the FTSE markets that I've analysed, the vast majority score minus. So to find a company that have actually got not only a positive score, but above 50, it's a decent potential investment. So thanks for watching. I hope it's been useful, guys. If you want to add anything to the video, if you've got any issues, any questions, please leave a comment underneath, and please like and subscribe, and I'll see you guys soon. Cheers.